Morning everyone, welcome to the Bank of England for today's Financial Stability Report press conference. To my far right is John Cunliffe, Deputy Governor for Financial Stability. On my left is Sam Woods, Deputy Governor for Prudential Regulation, and on my immediate right, of course, the Governor of the Bank, Andrew Bailey. Andrew.
Well, good morning. Thanks, Jamie. Good morning. And welcome to the press conference for the July Financial Stability Report. So before answering questions, I'll highlight some of the key themes from the report and from the FPC's second quarter policy meeting. In doing so, and in particular, I'd like to draw out the FPC's decision on the countercyclical capital buffer and this year's stress test, as well as our monitoring of financial stability risks from commodity markets. But let me start with a few comments on the backdrop to the latest report in terms of recent developments. As you would expect, given the focus of today's press conference, I'm not going to discuss monetary policy. That, of course, is for another occasion. Since the last FSR, which we published in December last year, the global economic outlook has deteriorated markedly. Global financial conditions as a whole have tightened significantly. This is in part due to central banks across the world having tightened monetary policy in response to the outlook for inflation. Market interest rates and corporate bond spreads have also risen, in part reflecting expectations of further tightening of policy. And developments in Russia's invasion of Ukraine are a key factor affecting the global outlook. That said, banks continue to hold overall capital and liquidity resources sufficient to support lending to the UK economy, even in severe economic outcomes. And those severe economic outcomes can include weaker economic growth globally, a further sharp tightening in global financial conditions, and the potential for further volatility and stress in financial markets. So despite the weaker outlook, the UK banking system remains strong. And in line with expectations, although capital ratios declined in the first quarter of this year and are expected to fall back slightly over coming quarters, all of which was expected, I want to underline this point that we have a resilient system. Now let me move on to the UK countercyclical capital buffer, the CCYB, and the decision. At the end of last year, in December, the FPC judged that it was minded to announce in the second quarter of this year, so now, that the UK CCYB rate would increase to 2%. This was because the vulnerabilities that could amplify economic shocks had returned to pre-pandemic levels. And this decision would bring the CCYB back to the level it was due to reach before the pandemic. And is still consistent with that slight decline seen in overall capital ratios that I mentioned earlier. These two things are not at odds, let me stress. But it's the FPC's judgment that it's the right time now to lock in resilience so that we are well prepared for future possible shocks. And in that spirit, therefore, consistent with its December judgment, today the FPC is increasing the CCYB rate to 2%. Now, as required by the operating rules of the CCYB, that rate will come into effect in July next year. Given considerable uncertainty around the outlook, the FPC will of course continue to monitor this situation closely, and we stand ready to vary the UK CCYB rate in either direction, depending on how risks develop. Let me turn to the stress test for this year. We're also setting out today that the Bank of England will launch its next stress test in September. This exercise will support the FPC's monitoring and assessment of the resilience of the UK banking system to several potential downside risks. And those will include deep simultaneous recessions in the UK and global economies, real income shocks, large falls in asset prices, and higher global interest rates. We expect to publish the results of the stress test in the middle of next year. Lastly, let me turn to commodity market vulnerabilities, which there is coverage of and a particular focus on in the report this time. The report highlights some of the financial stability risks posed by the recent volatility in global commodity markets. Since the Russian invasion of Ukraine, there have been sharp spikes in the prices of gas and other commodities. These spikes have led to steep increases in margin requirements for the financial contracts used by commodity suppliers to hedge their risks. Margin requirements are an essential tool for reducing risks in the financial system. In the early period after Russia's invasion, the sharp and sudden increases in these requirements made it harder for some commodity market participants to meet them. This put pressure on some commodity firms' liquidity positions. As a result, banks faced significant calls from their commodity firm clients to lend to them in order to then fund their higher margin requirements. Now, despite this price volatility, commodity and wider financial markets overall have continued to function. But in one particular instance in March, the London Metal Exchange temporarily suspended trading in nickel contracts and cancelled trades due to a specific set of circumstances that contributed to an extremely sharp price spike. Looking forward, the uncertainty surrounding the Russian invasion of Ukraine means that there remain significant risks of further disruption in commodity markets. The recent disruption has highlighted how vulnerabilities within commodity markets and interconnections with the wider financial system could amplify shocks to the real economy. Some of those vulnerabilities are similar to those in the wider system of market-based finance. Quantifying the size and scale of these fragilities and interconnections remains challenging for a number of reasons. There is considerable opacity and a lack of data in some markets, and some of these fragilities relate to physical markets, non-financial entities, or entities in other countries and outside the UK financial system. This means that addressing them will require engagement from a broad range of financial and non-financial authorities, both domestic and global. And in view of this, the Global Financial Stability Board is undertaking in-depth analysis and assessment of vulnerabilities in commodity markets. And the FPC welcomes and supports this work. The FSR today outlines a number of improvements that could be made to current data reporting. These include in relation to transactions and market participants. They should be done in a coordinated manner globally to enable enhanced surveillance of these markets by authorities. The FPC will continue to monitor the sector, and we stand ready to engage with other authorities as necessary to ensure resilience of the financial system to a stress in these markets. So to conclude, in summary, financial markets, particularly for commodities, have been volatile in recent weeks, but they are functioning. The economic outlook is uncertain and undoubtedly a very challenging one for many households and businesses. The banking system is resilient to that outlook, however, or indeed even a much worse one. And that's a sharp contrast to the financial crisis. We have a system that is in a position to cushion the economic shocks, not to add to them. Thank you. So we'll now take questions. Thanks, Jamie.
Yeah, questions. Wait for the microphone, please, and if you could identify yourself. Stick to one to begin with, then we go around again. Kate, why don't we start with you?
Thanks. Kate Ferguson at The Sun. You say that currently you're in a position to cushion the economic shocks. I wondered, how bad would inflation have to get, or how much worse would the economy have to get for us to be looking at a situation when people are defaulting on their mortgages and it gets a lot worse for everyday households? And secondly, if I may, in your report you talk about 1 in 3 SMEs not having enough cash flow to see them through 7 days. Can you talk a little bit about that? How big a problem is that for that sector of the economy? How worried are you about SMEs? What SMEs are we talking about? Thanks.
Well, let me start off. I'm sure John and Sam will want to come in. And very good and important questions. And obviously, we'll take households and SMEs separately. I think a key point to make on households is that there are a number of factors which do have the right sort of what I might call buffering and protection effect. So let me start by saying, and I've said this before, and I said I wasn't going to say anything about monetary policy, and don't take this as any comment on what's going to happen, but it's an important comment on the inflation we're seeing, that it is important, and it is, I'm afraid, very unfortunate, that because it's concentrated in the sort of what I call the essential goods that people consume, so obviously particularly in energy and food. It therefore affects low-income households more severely because quite naturally their consumption is more weighted towards those essential goods. And we're very cognizant of that. Now, the measures the government has announced on energy are very welcome in this respect because they are targeted at low-income households, and I think, I think that is absolutely the right thing to do, first of all. Secondly, we have taken a number of steps as the FPC over the years to ensure that the vulnerability of households to debt problems is more manageable. And I would particularly mention here the mortgage measures that we've taken. The so-called loan-to-income flow limit is important there because it does act to if you like, put a cap on the number of households that are exposed. There has been a growth also in the proportion of fixed-rate mortgages in the market, and that too will have obviously an effect in terms of buffering the immediate effects. So those things are important. There is also, and John may want to come talk about this, there's quite a helpful chart, or two charts actually in the report, and I'll leave John to talk about those. On SMEs, just briefly for me, and then I'll hand over. I mean, you're right to highlight SMEs because in the report we do highlight a difference between, if you like, the resilience of larger firms and SMEs. What I would say is the report does point out that more SME borrowing has been done at fixed rates, and that will obviously help to buffer. And then I'd come back to the general point I make, and this is very important, that the banking system is now more resilient. It has the capacity to support SMEs through difficult periods in ways that we didn't see during the financial crisis. But John, I'll hand over to you.
Yeah, I think I'd say the proportion of households who could get into real stress on their repayments, it's normally when repayments are about 40% of your income, is a number we always watch very carefully. And we always look to see what interest rate increases will be needed to take that share back to historically high levels we've seen in the past. I think it's about 2.7% was the highest we saw before the financial crisis. Of course, households now are facing a cost of living squeeze and they're facing higher interest rates. So what we've done, and that's the charts that the governor referred to in the FSR, which are worth looking at. What we've done is we've tried to calculate, we put the cost of living squeeze and the interest rates. I'm not going to tell you where Bank of England interest rates are going to go, you wouldn't expect me to, but the interest rates that the market is expecting. Okay, so we put the market interest rates in and we put in the cost of living squeeze. What's going to happen to that number of households that get into basically debt service as a high proportion of their income, both for mortgages and for consumer credit? And I think as the governor said, the impact this year is not expected to be great. In part, that's because of the government's action, which is cushioning the impact on lower income households, and in part because a lot of mortgages, majority of mortgages now are fixed rate for 2 to 5 years, so mortgage rate increases come through more slowly. We expect that to rise next year, but we don't expect it to go back to some of the historically high levels we saw, say, before the financial crisis. Of course, I mean, there's great uncertainty about what will happen, for example, to energy costs, which is dependent on what happens following Russia's invasion of Ukraine. But as it stands now, on the basis of the Monetary Policy Committee's forecasts on market interest rates, we don't see that share rising that much this year. We see it rising further next year. But that's about debt distress. That's not to lose the point that for many households, particularly those at the lower end of the income bracket with few savings, cost of living squeeze is going to exert real pressure. And you recognise that. Thanks.
The charts are on page 21, by the way, just for reference.
Yeah.
Ben Martin from The Times. Can I ask what lessons has the bank learnt so far from its review into what lessons and insights has the bank learnt so far from its review into what happened at the LME earlier this year?
Well, obviously on the LME, there as you know, two reviews going on. One is in our area of responsibility, which is the clearinghouse, and the other one is the FCA's. I think the thing that I would point to initially, and again, John may want to come in as well, is that one of the things the LME has already done, and I think this is a very important thing to do, is that it has required more transparency in the OTC, over-the-counter positioning in these markets, because I think one thing that's clear from that incident is that to judge and to risk manage in a market like that, where you've both got OTC trading and on-exchange trading, you have to see the whole picture. I think to think that you can risk manage by seeing one part of that picture, I think, as we saw, opens up the risk, and particularly when you get very large positions, as happened in one part of the landscape, that's the OTC part actually, that obviously then, in a sense, rebounded into the exchange traded market part of it. So obviously, I say that the reason I highlight the reviews going on is that this is by no means over, but I think that is a particularly important first step to take. John, did you want to?
Yeah, as I say, we'll have to see where the review comes out, and I don't want to preempt that, but we saw general stress in commodity markets after Russia's invasion of Ukraine. You saw it in what happened to industrial metals, but what we saw in nickel was something much more extreme than what we saw in other industrial metals. And while the invasion of Ukraine by Russia, clearly a factor in putting general stress on the market, there are a specific set of circumstances, I think, operating at the London Metal Exchange. And one of them, and I think a very important one, has just been said, is there was a very large short position in the over-the-counter market which couldn't be seen. And when that position was squeezed, the prices came into the lit market. I think there are some really important lessons there about transparency in these markets, so that players can see that. We saw that transparency issue also in a very different world in Archegos, when a number of the players didn't really understand what was in the market. So I think there'll be some lessons about transparency. When you get a price increase where the price doubles overnight and then doubles again, there are questions about to what extent you need speed bumps in the market. Other markets have them. And then, of course, there's a question of have very different sorts of players in commodity markets and other financial markets. You've got people who are supplying the real economy, you've got people who are hedging, people who are speculating, and the like. We need to think about the resilience in those markets. So I think while there are specific circumstances, I think there'll be general lessons to learn as well for the way these markets operate.
If I could add, I think it's important to bear in mind, just developing what John was saying for a moment, that for some of these markets, some of these metal markets, for instance, the sort of what I might call the structural demand for these metals is changing, because they're actually in demand, particularly for sort of sustainable products like batteries for cars and electric batteries for cars. And I think it's important that the market structures keep up and reflect the sort of the change in the sort of supply-demand balance in these markets that's going on, and indeed the size of these markets, because certain commodities are now obviously highly in demand for these environmentally sustainable products.
Thanks. Joel next, and then Will, I think.
Hi there, Joel Hills from ITV News. What level I'm just looking at chart 1.3, what level would bank rate have to reach for debt servicing ratios on mortgage debt to return to pre-financial crisis levels? Look like 2.8% here, isn't it, of percentage of households? So yeah, what level would bank rate have to reach to get back to those levels, please?
Well, we stress the market rates quite substantially. It's not a straightforward question, I think, because of the shift, as John was just saying earlier, towards a fixed interest rate structure. For a lot more mortgages are now on fixed interest rates, and therefore the pass-through of changes by the Monetary Policy Committee and bank rate takes effect differently. John, did you want to?
So I think, sort of illustration, I'll give you a number which is easier to calculate, I think, on the corporate side. And again, there are uncertainties, but as the paper discusses, you'd need to see bank rate going somewhere between 200 and 500 basis points over where the market is expecting it. So I think the market's got interest rates going to nigh on 3%. So you'd be looking at sort of 5 to 7 to 8 on the corporate side. The picture is not that dissimilar on the mortgage market side, but again, you've got mortgage market, consumer debt, and you have got this you have got this this question of how it comes through over time. I'd say on the corporate side, it's important to remember that some of the corporate debt is fixed rate, some of the corporate debt is floating rate, and you have to make assumptions about what proportion is what, which is why there is a range. But these are rates significantly above, maybe the best way to say it, rates significantly above where the market has them at the moment.
There's a lot more resilience in the system in that sense. So the figures John was giving, I mean, for the corporate sector, for large corporates, I mean, the bank rate curve, I think, currently goes up to about 3%.
Yeah,
So the numbers John was giving are on top of that.
William Shaw from Bloomberg. The government's interested in the possibility of very long mortgages, possibly 40, 50 years. Do the Bank of England and the PRA view that as something that would help people cope with interest rate rises and the general strain on affordability, while also unlocking home ownership for younger people, or are there potential risks around that?
Well, I'll hand over to Sam. I would start with a general point here, which is that our approach, as you know, as central bank and regulator, is that we will, you know, support and engage in any process which wants to sort of, in a sense, you know, envisage innovation in the market of that sort. You know, it's something that we would certainly, you know, support review of. To see what is possible in the market. So, you know, if it comes forward, we will certainly play our part in it. Sam, do you want to?
Thanks, Rueda. Thanks, Will. I'd say, look, we've got a completely open mind on it. So that's not currently a feature of our market. But as you know, and as we point out in the report, there are other markets which function perfectly well, non-UK markets, which do have much longer fixed rate mortgages. I think not often 50 actually, but much longer than we're used to. So I think if such a product came forward in the market, we'd approach that with an open mind, whether it could be provided by banks or by insurance companies. But I think our job would then be to just make sure that the prudential regulation could be adapted as needed to capture any risks that came with that.
Thanks. Lucy, then Sid, please.
Hi, Lucy Hager from Market News. Just returning to the climate topic, what is the biggest potential green swan risk that you're seeing to financial stability? And are you seeing any more medium-term risks of financial stability as adoption of climate change measures get pushed back due to the invasion of the Ukraine?
Well, I think, you know, our approach on climate change is this. You know, some people sort of sometimes say, you know, it's a bit dilettante for central banks to be involved in this, and I really reject that. Just to give you a little bit of history, actually, it's worth starting with a bit of history. You know, the Bank of England started its work on climate change, actually, you know, in the PRA on the insurance industry. And the reason for that was that, you know, insurers typically hold assets for much longer and therefore are much more exposed to sort of the long horizon risks. And therefore we could see that climate change was going to come into our world, as it were, directly, you know, first through that channel. But what, of course, we've seen subsequently is that it's right to extend that to both the banks, but also actually to the economy more broadly. I mean, even as I said this morning, I'm not going to talk about monetary policy, and again, I'm not speculating on monetary policy, but the point I want to make is that, you know, this is affecting the economy around us, as we know. And so therefore it's important that we do look at it and that we do take it seriously, and that's why I do push back on you know, people who take the other view. And that's why the bank does regard it as something that it's important, as do other central banks, by the way. And we are doing a lot of work at the moment with other central banks globally on macroeconomic scenarios which seek to build in and model climate change more effectively. Now, of course, it is a medium-term risk because the time horizon for these scenarios and the time horizon, obviously, for the adjustment, the adjustment that needs to be made, is much longer than we normally deal with. Certainly, in our, you know, if you look at our stress tests, for instance. But that's appropriate given the nature of the risk. So it's appropriate that we have both a short-term and a medium-term focus in this respect. Now, I should say that, you know, medium-term economic scenarios are essentially, of course, quite challenging in the sense that obviously the uncertainty goes up the further you go out. But I think, and you probably saw the work we published as a result of the exploratory scenarios, and I say those are the scenarios that with other central banks we're going to keep working on to develop. that I think it's absolutely essential that we do this work. I should also say that there are other very essential parts of the work going on, which we're heavily involved in, both as the FPC and because all three of us are heavily involved in the Global Financial Stability Board as well. So I would put a lot of emphasis on the work that is being done by the ISSB to produce consistent reporting and measuring standards. And I'm optimistic. I think that work is coming along very well. And I'm optimistic that well, I think, obviously, countries will want to do somewhat variants of their own approaches. I understand that, but there will be a core of standards in there for reporting and measurement, which will give us a much stronger basis to go forward, both domestically and internationally. You want to say?
I could just add very briefly, Lucy, just one point on the exploratory scenario that we ran, and we provided a summary of that in this report as well. It's interesting that we found from that the cost of the transitional paths to the banks and insurance companies on the somewhat necessarily stylized scenarios that we ran will be equivalent to 10 to 15% of annual profits through those very long scenarios. And my comment about that would be, one, that is obviously a very significant number and something that firms will therefore need to manage. But two, it's not obviously the sort of thing that we would leap to a need to capitalise up front with a special new kind of climate requirement. Now, that's not a settled position, but I think that's a reasonable point to take from what we published. The big caveat to that is that what we did not test was a trading risk stress. And I think the most obvious way to think about that is a kind of policy shock. If you had a sudden and unanticipated hardening of climate policy, perhaps in reaction to some event that happened, that could potentially move assets prices around in a very dramatic way. And I think that bit we have to come back to.
Thanks, Sid.
Hi, Siddharth Venkaram-Krishnan from the Financial Times. I was just curious on the note of the tentative signs of tightening lending, whether you're concerned at all about areas of subprime lending, such as buy now, pay later, taking a lot of the slack, and what impact that might have on broader market conditions.
Yes, I can take that one. Thanks. Look, what we're seeing, as you say, is just very tentative signs of tightening. We talk about this a bit in the report, but what you're seeing is banks, I think very sensibly, adjusting their own affordability tests to take into account cost of living pressures, which I think we would expect them to do on extension of new consumer credit, perhaps moving up the creditworthiness scales a bit. I think all of that you would anticipate. It's quite small at the moment. Whether if the banks tighten, that supply of finance in effect spills out to non-bank lenders of various kinds, there's buy now, pay later, but there's also obviously many others. That I think is an open question, and we'd have to see what happens. What I would say though is that the FCA, I think, has been taking very sensible steps to control bits of that market, particularly the high-cost lending market, so to prevent, if you like, a perfectly sensible thing happening in the banking sphere, leading to a worse consumer outcome in those non-banking areas.
Thanks, August.
Hi, August Graham from PA. In the past, I think it's fair to say that the bank said that there's not been much impact, or there's not much risk to the regular financial system from the crypto market. Now, in the recent collapse there, I was just wondering if that's changed your mind at all, if there's any new assessment on that front.
Well, I'll start. I know John will want to come in because we both spend a lot of time on this, both domestically and internationally. First of all, of course, I'm afraid it hasn't changed the underlying view, and particularly I'm talking here about what we tend to call unbacked crypto. I'm going to make the distinction between unbacked crypto and so-called stable coins. I've been saying for a number of years that unbacked crypto, in my view, doesn't have intrinsic value. Doesn't mean to say, of course, it doesn't have value, but it doesn't have intrinsic value, and that people should be, very clear on the risks that are being taken there by investing in it. I think both the experience that we've had in recent weeks and also the work that we're doing, both domestically and internationally, I think further draws out that there are issues both in the unbacked crypto world and the so-called stablecoin world. I tend to final thing I'll say before handing over, I tend to draw the distinction that I think unbacked crypto is better viewed as an investment, say, bearing in mind what I just said about intrinsic value, but I mean as an investment. So, quotes store of value. I say that's heavily qualified by what I just said. Whereas I think stable coins are better viewed in terms of thinking about the uses of money as a means of payment. Now, I think we are both domestically and internationally, therefore thinking about these two things together, because obviously they're both developing quickly and there are interconnections, but I think they need a different lens in terms of how, and that's what we're doing in terms of how we approach it. I'll hand over to John.
Yeah, no, thanks. So I think what I'd say is we reached a judgment last year, a number of us publicly, that the crypto market had grown very quickly. I think 2.3 trillion, 2.4 trillion, was growing, was starting to be integrated into what I would call the non-crypto conventional financial sector, but it wasn't yet of a size or integration that was a financial stability risk. Well, it's lost. If you're looking at crypto assets, 70% of its value for Bitcoin and Ether, I think, will be the ones to take in recent weeks. We haven't seen an impact on the financial system as a whole, so that judgment, I think, that it wasn't yet at a point where it would cause a financial stability risk, for the moment anyway, is borne out. I think what's also borne out, bluntly, is that technology doesn't change the laws of economics and finance and risks. It may enable you to manage them in different ways, but if an asset is speculative and has no intrinsic value, it's only worth what somebody pays for it, it can go down very quickly when confidence is lost. If you use something, as Andrew says, as money in a transaction, you can call it a stable coin, but if people lose confidence in that because they don't see how it's going to maintain its value, think Terra, think Luna, then you'll see stress across the system. If somebody borrows short to invest in highly speculative assets, we call it leverage, when those assets start to drop in value, there's a real pressure to sell those assets in fire sales. And we've seen that. We've seen all those lessons play out in the conventional financial system. That's why we have regulation to deal with it. And I think for me it underlines the fact that we need now to bring in the regulatory system that will manage those risks in the crypto world in the same way that we manage them in the conventional world. There's not something intrinsically different, because the technology, though, you may have to apply the rules in a different way. So I wouldn't take the lesson that we don't have to do anything because this has gone away. I think the technology has some real potential for use in the financial system more generally, but we do have to get on with the work of putting in place the regulatory framework, same risk, same regulatory outcome. And I think you've just seen the need for that in what's happened.
And I would add, it's key that the work is done internationally, because these are, as you know, these are international markets in that sense. These are instruments that cross borders very easily.
That was the last one on my list, if anybody wants to come back in. If not, then thank you very much indeed for coming, and we'll see you soon.